The reason for our Tuesday masterminds is we help people decipher and demystify some of those tax strategies that maybe they thought were only available to Fortune 500 companies, that literally many of these tax strategies are available to individuals who are business owners and who are making $1 million and more. So you can see there's a big difference between income of $1 million versus income of, what the Fortune 500 companies make. Now, we don't necessarily implement these strategies the same way that some of these larger publicly traded companies do. There is a proper way of doing things so that it makes sense for our mainstream business owner. And that's why we're here today. That's why we're here every Tuesday. And today, out of all days, we have a guest speaker, the renowned Ken Crabb. Ken Crabb has a bio that's attached to your registration link. And for all of those of you who have not had a chance to read Ken Crabb's bio, Ken, if you would unmute yourself. I see that you're.
I think I did.
Very good. If you'll go ahead and give us a little bit of your background and history and what caused you to come up with this strategy. We have a little bit of agenda today. So first we're going to do introductions. If you'll introduce yourself, then I'll talk about some of my clients that we've worked on in the past. And then we have a deal on the table right now that we'll go over as well in the group forum. And then we'll do Q&A at the end. And that'll be probably the last 25 minutes. We'll do Q&A.
Perfect. Jake, I was just going to say there's a little more gray in the goatee than the last time I saw you, my friend. I didn't want to.
We'll call it the pandemic aging. That's what we'll call it.
It's wisdom. Those are wisdom. That's the wisdom color. No, my name's Ken Crabb. I live in Charlotte, North Carolina. I've been in the financial services industry since 1993, but I moved to Cleveland, Ohio in 1999, where I took a position with a billionaire family office, and I was tasked with building out their life insurance silo. They owned a lot of different public companies. One of the companies they owned was Rawlings Sporting Goods, so it was a big, serious family. And they had tasked me with finding a solution to purchase life insurance using corporate dollars that were mostly tax-free. I searched the United States over. I found 47 plans that purported to offer such a deal. And my client's two separate tax law firms said no 47 separate times. So we ended up going to work on what is today called the Restricted Property Trust back in the fall of 1999. We did our first trust in February of 2000. And the only reason I'm still around is when we sat down to originally design this, we were designing it for one taxpayer in Cleveland, right? So we were designing this to defend it, not to market it. Hey, if you sit down at a tax table and you're like, what can we design that's really, really attractive and people will buy? That's a tough starting point to land with something legal. But our starting place was, what can we actually defend should the IRS knock on our door? And so that was the genesis of the Restricted Property Trust. I rolled it out to the public marketplace in 2003 and have been cruising along ever since, not without plenty of adversaries. And I've been in federal litigation. I've had audits, appeals. I've been deposed by the Department of Justice. My emails have been subpoenaed, all kinds of fun stuff over the past couple of decades. But the plan continues as is. And it's the same thing that it was 22 years ago when we did our first trust.
That's a wonderful story. So Ken, I appreciate you sharing how this came to be and how you built it to defend it for one particular client, and how it can also work for a lot of other people. And the way that it was built to be able to defend it, and the fact that it's been put to the test. That's incredibly important, because if a strategy is too new, it's hard to recommend it to a client. And what would an example of that be? For case in point, I had the great opportunity to be fed by the fire hose. I was kind of like the back office for a very large accounting association that had over 10,000 accounting firm owners that subscribed to it. And during that time, I was charged by these accounting firm owners to look into and discover the validity behind certain strategies that their clients were being pitched, sometimes at dinner seminars, sometimes at events and conferences and everything else. And I ended up building out a criteria of all the things that I needed to check off in order to actually put my little blessing, so to speak, on a strategy for the group. And a lot of those were When was it formed? Is it still structured the same way today that it was originally structured way back when? And if not, why? Has it been tested, right? And what were the outcomes of those tests so that we can understand when it works and when it doesn't? But interestingly enough, with this strategy, this is only one out of two of 423 strategies that we had with this association. This is only one out of two that remains the same from when it was originally constructed. And that is impressive. And I just wanted the entire audience to hear that, because there are very few strategies out there that still exist today the way that they were originally formed way back when.
Yeah, that's true. Usually after, and you guys are going to be familiar with IRS notices, but when the IRS issues a notice, whether it be to the captive marketplace or the conservation easement marketplace or whatever, you see a lot of administrators make significant changes to how the plan was designed to survive the challenge. And I think to Jake's point, the RPT, it's now a very successful strategy. It was the least successful corporate tax deductible life insurance strategy in America for a very long time, because the other strategies were 100% deductible, get all your money back tax-free, which is awesome, unless you have to defend the tax reporting there. And then the big joke is now the RPT hasn't changed. I'm just Forrest Gump in the shrimp boat. It's the only corporate tax deductible life insurance that survived the storm. And so it's the same old rusty old shrimp boat, and it works the same way. But to Jake's point, it hasn't changed at all in over 2 decades.
I love to hear that. We're going to post that over the next ad. The Forrest Gump and the shrimp boat of restricted property trusts, right?
Yeah, that's right.
Oh, very good. Well, anyway, let's talk about a couple of my clients that have used this. We have a couple of owners out of California that own a fulfillment center. Essentially, they design clothing that then is made somewhere else. It's drop shipped in and then sent to the client. Now, these clients had a record year during COVID. In fact, they came to me and they said, oh my goodness, we're going from the 1.5 million annual gross sales to 18 million in 6 months. What can we do? So we pulled out the drawing board, we kind of mapped and structured everything out, and then it was time to look at retirement plans. Of all the types of retirement plans we could incorporate, things were very heavy on the two owners, because the two owners, they were the owners, they were the operators, and sure, there were other contractors, employees here or there, but there was high turnover and everything else. So we wanted to design something that was specific to the owners themselves. And so then we reached out to Ken Crabb. And Ken, what is the process? What do we need to do when we first explain a restricted property trust to a client?
Yeah, I think that there's 3 things that I always want clients to have perfect clarity on prior to looking at the numbers. So, and Jake will tell you, we have a cash flow comparison, which is just a 1-page selling sheet. It's the only page I walk the clients through, but I don't even walk through that until we're all agreed on 3 things. First, clients should rightfully ask, hey, you're going to be taking a deduction on my corporate tax return, especially if their CPA is on the phone. If this is challenged by the IRS for any reason, do you help in that audit? And I usually quickly say no, and then I pause because it's a nice effect there. They freak out. The answer is I don't help. I do everything A to Z 100% at my expense. And Jake's very aware of this, but on March 3rd of this year, I was defending a case that went to the 6th Circuit Court of Appeals and was deemed, it was for a client of mine called Mann Construction. It was on the front page of the Wall Street Journal on March 10th. But the 6th Circuit Court of Appeals found that this particular structure could not ever be considered a potentially abusive tax shelter, so there's no potential for penalty ever. I paid for all of those litigation fees. There were a couple of commas involved in that process. But if I have a client that's challenged anywhere for any reason, I come in with myself and 2 different law firms, and I defend that 100% at my expense. So I will literally take everybody's tax risk to 0. And I don't do that because I'm generous. I don't do that because I'm friendly. I do that because I'm greedy. And my brand value is worth a lot of money to me. So it's actually worth it for me to spend a couple of $1 million defending the plan in federal court. It's no fun. I don't want to do that, but I'll absolutely do that to keep my own personal cash cow going. So that's step 1. Step 2 is, as Jake knows, we have a 5-year minimum commitment. So when someone signs up for the restricted property trust, they are on the hook to make that payment to the trust for no less than 5 years. And prior to the 5th payment, they can choose if they want to extend it for another 5. But that rolling window is always going to be a 5-year tranche. And there's very specific tax reasons for that. If you guys are familiar with restricted property as defined in Section 83, you would see that. And so that's what we have. But if a client doesn't fund it for any reason, our third-party independent institutional trustee will surrender it for cash and give it to a previously selected charity. So that is our risk of forfeiture that gives us all the tax treatment. And when I'm talking to clients, I want them to very clearly understand that. A lot of times I will scare the client, and instead of putting $200,000 in, they will put $100,000 in. And then 3 years later, they'll call Jake and I, and they're mad at us because they wish they did 200. That's a good phone call for me, because that means they're happy. That means they want more. What I can't have is they decide to put in 200 and call me 3 years later and say they wish they did 100. That's a bad phone call. I can't fix it. So I want to make that very, very clear to clients that yes, I'll take your tax risk to 0, but the 5-year risk of forfeiture, I can never take to 0. That is a real thing. And then the third and final thing before we look at the numbers that we need clarity on is, what is the reasonable business purpose for the death benefit? In other words, why does the company want to have a death benefit on this person? I'm going to give you a terrible example, and then I'll get you back into the real world. We started working with pro athletes the summer of 2015. We now have several dozen very, very high profile professional athletes. The very first case I did was on a 25-year-old kid, and his group of advisors wanted him to put $1 million in. The problem with that is pro athletes tend to be very young and healthy. Otherwise, they wouldn't be pro athletes. So the death benefit was about $120 million. And my audit defense would have been to say that it's reasonable to assume his mother needs $120 million to continue this endorsement company if he dies. And I was not willing to put my 100% track record on the line to defend $120 million. I lowered the contribution to $150,000. Imagine the insurance advisor there. I just dropped the commission by 85%. They were not super excited about that. But now I have about 15, 16 million in death benefit, and this endorsement company has rights. The shoe company may not pay. Other companies may start using his image to sell stuff. I just wasn't willing to put $120 million against my track record. So that's number one, the reasonable business purpose. In the real world, what that actually means is I will typically do 10 times W-2 as a death benefit. I will do a combination of W-2 and K-1 at a multiple of 5. So if you have a client with $1 million K-1 and a $200,000 W-2, $6 million would be the reasonable death benefit there. If they're 28 years old and they're in great health, that's not a big premium. If they're a 65-year-old smoker, we can get a lot of money in here, right? So it just depends on the age of the client, the contribution amount. And it's really my job to say, okay, based on this corporate tax return and based on the age and health of this client, I'm willing to defend X amount of dollars. I may come back with a number that's much larger than you guys want to do. And that's great. You don't have to say, oh, okay, Ken will defend $500,000 here, but we only want to put in 100. That's awesome. You just can't put in 600, right? My job is just to come in and give you guys the ceiling to it. And then once everybody understands those 3 things, the tax risk, I'll get to 0. The 5-year commitment is very, very real. And we do have to have a reasonable business purpose for the death benefit. Then we get into the actual product and the design and all.
So at the end of the day, we end up with a retirement plan, which your role in this is the TPA. We'll discuss what that is here in just a minute. But we have a retirement plan that is deducted by the business and based on the restricted stock rules and other things. I mean, there's this death benefit that is an ancillary benefit that we do pay some taxes on every year so that we can take it all out tax-free at the end. But with all of this being said, we have a retirement plan only for the business owners that they can then take this wonderful benefit once the trust is dissolved and use it like any other cash value life insurance plan at that point. The efficiency here, for example, these clients of mine, when we built them out a tax plan, of which, by the way, out of 18 million, we showed them around 4.9 million of tax savings. We had insurance companies that they were putting together. We had inventory strategies and what to do with unusable inventory and donating to a charity. We had just a number of different things that proved to be more efficient from not only a business operating standpoint, but from a tax flow standpoint. And kind of the dessert at the table, the dessert at the dinner table was the restricted property trust. These were younger business owners. And based on their future ability to always pay into this, if in case the pandemic year was a unique and high revenue year compared to future years, we did a $200,000 contribution for one owner and a $50,000 contribution to the other owner going into the restricted property trust for the two owners as an owner-only retirement plan. And that has been good for them. And we're now on year 3, and everything is moving forward as planned. This is their retirement plan, being the owners and the primary operators and the brains behind everything, to where now they feel that the tax flow has provided so much tax savings, they've been able to build these additional assets. And that's been a wonderful thing. Now, Ken, we do have a series of CPAs and other tax advisors, some CFOs, and we have 4 financial advisors on the call. Can you, a lot of people here are familiar with what a TPA is, but not everybody. Can you kind of tell us the role of the TPA and why you bring in the law firms and everything else, and what your role as the TPA is in all of this?
Yeah, and I saw one other question come by prior to that, says, what is this? We're really, the only asset that's ever held in the restricted property trust is a whole life insurance policy. So this is whole life insurance. It's not universal life. It's not indexed universal variable. It's always going to be whole life. And when we landed there, and there's a tax reason for that, but when we landed there over 20 years ago, I was disappointed. I'm telling you, that has been the most wonderful part of my career, because whole life is so beautifully boring. And if you think about the last 22 years in the United States of America, we have had a lot of periods of time that have been anything but boring. Personally, I'm sure everybody on this call has seen their stock holdings skinnied this year. I know that I have, but the money that I have in whole life is the exact same as it was when the year started, and it won't change until November 6th, which is my policy anniversary. So it's a whole life insurance policy. And essentially, to answer the first question, every time a business writes a check for $1 to the trust, to the whole life policy, 100% of that will be deducted to the business, and 30% will be included on the owner's personal return, thereby reducing their net income by 70 cents on the dollar. So it's a whole life insurance policy that we're basically buying it with, call it 65-cent dollars instead of 100-cent dollars. And when you do that, the math improves. Another great question, can you borrow against it? No, the only thing you have access to in the policy during participation is the death benefit. And there's only one way to get that out. I've had 4 people get it out that way. They did not volunteer for that, but they passed away. Otherwise, it's forfeit. But my role as the third-party administrator, first and foremost, is to oversee the administration, set the plan up properly. If it's ever challenged, I defend it 100% at my expense. My office and my team, we deliver a tax memorandum for every CPA in January on every single trust around the United States on how to complete the personal tax return. That's just a little bit of a cover my own rear end sort of thing, because we have people that make mistakes when they're filing it. And I go back and say, oh, you remember this 7-page report we sent you in January? Well, you didn't file it that way. So we deliver that every single year. And I'm going to try and stick to my task, and I'll get to the questions at the end because I see them firing in. But then we're going to invoice through you guys. And Pearson's having fun with it. Then we're going to invoice 30 days prior to the premium payment. We will send an invoice to the advisor on the case. We service all of these through our advisors. So technically, you guys are our clients, not the clients. We're here to serve you. And then prior to any 5th premium payment, whether that be a 5th, a 10th, or a 15th, well, it won't be a 15th, but a 5th or a 10th, we're going to send that invoice out 60 days prior, which just gives us an extra month. If someone needs a phone call, hey, how's business? What's going on? Should we keep doing it? The answer is absolutely. We want to give you an extra 30 days to say, hey, is this something we want to amend and extend for that next 5 years? And my team will do 100% of the funding. 100% of the policy servicing while it's in the trust. Then once it rolls out of the trust, my team is responsible for issuing a 1099 from the trust to the insured to show the very small taxable portion on exit. And then then it's on you guys. Then it's just a big fat whole life insurance policy after that period of time. But we're going to, my team will be there. And actually, I'm not very gifted administratively, but my chief operations officer is a genius with administration. And so he runs over 1,000 of these trusts nationwide with just 4 other staff, which is pretty impressive to me because I would never be able to do that. We're going to be with everybody every single step of the way until vesting. And that's when we wish you the best of luck.
That's right. Investing is somewhat at the client's discretion. Should they want to be retiring? Should they want to move on to the next stage? If that 5-year period is gone, or if it's been a 10-year period, whatever, there's a point at which they take the asset out of the trust. And then at that point, they can use it like any other cash value life insurance policy. And at that point, they can borrow from it and everything else. But as you mentioned, Ken, during the accumulation phase, it is restricted. And so it is a retirement plan of which you can't get the asset out.
That's correct. I saw one other quick question, Jake, not to interrupt you, but on, can a bank enhance the funding of it, which we all have seen with premium finance? You cannot collateralize this policy, borrow against it in any way, shape, or form while you're in it. So this is never going to be a fit for premium finance. However, I will tell you that every single year, 10 to 15 of our largest cases are there to support a premium finance strategy. So for example, you guys have a client that needs $100 million of life insurance for estate plan. Well, they're probably going to want to go ahead and finance 85 to 90 million of that. We'll put a 10 to $15 million RPT on it. That's going to reduce their income during that period of time. We fund them both for 10 years. Once we vest in the RPT, we use the whole life tax-free income stream to pay down the note on the more efficient long-term legacy policy. And I love what Jake said. This is just your dessert. If someone's going out to a big steak dinner, I always say, hey, I'm just the side of Parmesan truffle fries. I don't need to be the big steak in the center of the plate. We probably have 24 Forbes 400 families as clients that own the restricted property trust, and it represents somewhere between 10 and 20% of their total death benefit. So it doesn't mean we're coming in there and selling them $100 million restricted property trust. It just means that their advisors are diversifying their insurance portfolio, and the restricted property trust offers a way to make that more efficient long-term. So
as in other words, we're moving assets from column A that are otherwise taxable. Now we're getting a deduction for passing it over to the retirement plan. We pay a little bit tax ongoing as we're making contributions. And then at the very end, we're able to pull it out as a tax-free asset. So there's some arbitrage and efficiencies. There's some taxes paid throughout, but at the end of the day, where somebody may have normally paid 40%, 42%, what have you, on ordinary income tax, federal and state, in a lot of these scenarios, the range is closer to 15 to 17% overall. And then you have an asset that is tax-free that you can pull from to assist with other strategies, as you mentioned, if it's the premium finance strategy, or if it's just income that in the future, where the 2026 Tax Cuts and Jobs Act sunsetting and all the tax rates going up, if it's just that you want to offset some of your taxable income with tax-free income, this becomes a suitable financial tool for that.
And you know what, Jake, may be helpful at this stage? Do you have the cash flow comparison handy that we could share the screen just for a few minutes?
Absolutely. Let me pull one up.
Numbers.
And then we should go over one of the ongoing deals that we have right now. Mark, if you wouldn't mind sharing some of those details after we go over this illustration. And so I'm just prepping you for that. Let's see.
Perfect. And what we're going to look at is a cash flow comparison. And we're going to take a look at whatever number Jake wants to throw up on the screen. It won't matter. Once you understand how to explain this particular spreadsheet, you'll understand any of the ones you look at. And really, prior for me walking through the client with this spreadsheet, that's when I bring those 3 things up and then say, okay, now that you understand those 3 things, we've got a starting point that we can all agree on. Then let's go ahead and see if the math makes sense. I mean, why in the world would you do this? And as far as where it fits in with your portfolio, I always tell clients that it really is like if you picture your asset allocation pie chart, picture your fixed income slice of the pie chart except we're going to be making 7 or 8% fixed with a free death benefit. And how much would you be willing to commit to something making 7 or 8% fixed with a free death benefit? That makes sense. I saw it, Jake. We had it. We were almost to page 3.
There we go. Should I go ahead?
Success. Yeah, just scroll down 2 pages for me if you would.
All right, we got a female.
This is perfect. This is a female putting in $100,000 a year. One more page. Go down to the next one for me. And right here. So this is a client. We actually designed this because this was a non-taxable. They live in a state where they don't have income tax. So they just have federal and Obamacare, which you can see the top marginal rate in those states is 40%. So what I'm trying to communicate to the client is, look, for you to put $100,000 into anything non-qualified, you would have to make about $180,000, $175,000. You pay your taxes, you have $100,000 left over. Congratulations. In the restricted property trust, in this particular example, $100,000 is going in. 40% of that is taxable to the individual every year as phantom income. So in order to cover that phantom income tax, that's an additional $26,667. So I need a pre-tax equivalent, not of 175. I need a pre-tax equivalent of 126 to get 100 into my plan. Let's assume your local banker calls you and says, wow, you're such a great client. I have a CD paying 8% fixed for 35 years. Okay. Hey, by the way, if any of you get that phone call, could you please email me immediately?
Right.
That would be great. But if you put the same gross income and you take it home, you only get to keep $76,000. If you were looking at a different life insurance strategy, you would only get to use $76,000 because there's no tax efficiency to it. And if you made 8% every single year for 10 years, in year 11, you would have a little over $1 million, $1,040,000. In the restricted property trust, yes, we have a taxable event on transfer, but we pay those taxes out of the policy and we still have over $1 million of cash value. And then, Jake, if you scroll to where we can see the bottom number in each column, perfect. And then you can see here, we can take $83,000 out for 20 years. If you did the same thing, it almost comes out spot on. In the last year, you could only get 49,000 out. So what we were really able to do is we were able to outperform an 8% rate of return and give you a free death benefit. And then one more example, and I'll turn it back over to Jake. When we look at this against a defined benefit pension plan or a cash balance pension plan, I can tell you right now that the cash balance pension plan will have more money in year 11 because it's 100% deductible. But once you want to start withdrawing and putting $83,000 a year in your pocket, you've got to pull $150,000 out. So what usually happens is somewhere in your late 70s or early 80s, the whole life policy has more cash value than your qualified plan. And if you'd have died any time before then, the death benefit is always tax-free and higher than the qualified asset account value. So the restricted property trust tends to outperform the cash balance pension plans and DB plans, whether you live or whether you die. If you die, it's a self-completing retirement plan. You gave a pile of tax-free cash to your family. And if you live, you have access to a very nice non-reportable, non-taxable income stream for a long period of time.
Okay, wonderful. So again, at the end of the day, this is a retirement plan. However, you don't have to be 59 and a half to get it out. You just have to go past the 5 years. And this is for the owners of companies. We have a number of questions here, but let's jump into a live story. So sometimes life is more than just simple cut and dry, hey, retirement plan. Sometimes people want to have a buyout as part of the business reason for 1, the death benefit, and 2, the cash value accumulation. So Ken, I know that you have a client in Ohio. Yep. In this scenario. We also have Mark here. Mark, can you say hello?
All right.
Let's see, Mark. There we go.
It's a great sunset, Mark. I'm not sure what time it is there, so I'm not sure that sunset's.
Yeah, no, this is that's another thing.
Yeah.
Anyway, just hello to everyone. Appreciate you considering my client problem. So
yes.
We'll talk about that.
Let's have Ken give a high-level overview of his client that he just helped with a very similar scenario to yours. Then let's go into your details specifically. So Ken, if you'll take the word first.
Sure. So we had a dad that owned a large manufacturing company in Central Ohio in Dayton. And he was spending most of his time in Naples, Florida, and his two sons are buying that business out over a 10-year period of time. It's a manufacturing company, so it does have some significant capital requirements. And if dad dies and the boys are getting ready to buy him out and they've got to come up with the cash flow and still have capital in the business, that could have been challenging. So what we did, yeah, it's minimum 50,000 per trust. But what we did is the boys are now putting $400,000 away a year for dad. That got us about a $10 million death benefit at dad's age. And if dad dies anytime in the next 9 years and 11 months, the boys are going to get that 10 million and use it to buy mom out. If dad lives that 10-year period of time, when the policy transfers to him, the net cash value of that policy will go against the final purchase price of the business.
Now, this is
Really was clean.
This is even better for succession planning because we don't know what the future tax rates are going to be, but we can project a future tax-free asset, like this whole life policy, what that value will be. We can predict that with very close certainty with
Yeah.
the whole life product. That's probably another reason why it's always a whole life product.
Yes. And I know I'm seeing a bunch of questions. I'm not keeping them up with them all, Jake. Are you looking at those? And we can.
I am. I'm screening those just for a minute because now I want Mark to share his client scenario and let's see how we can't compare those two. Mark, will you go ahead? Oh, you're on mute still.
I have a family with two sons eventually taking over their father's business. And I've always sort of called this the no plan because you give so much or sell so much a year, the value of the business continues to accelerate or get higher. You're either, having a growing gift issue or whatever. And I'm not quite sure how this trust would fit in there, but if you just every couple of years you're giving the kids or selling or giving the kids, the boys, another 15-20% of the business over a period of 5 to 10 years to where it eventually is owned by the sons. So how do I make this work?
Yeah, and it'd be very similar to what I just talked about. We could put a death benefit on dad for the outstanding equity value. Start funding that. The nice thing is that's going to reduce the business's net income. So if he needs to put 250,000 in, the business net income goes down by the full 250, which helps with the valuation a little bit because that's an expense.
Right.
30% or 75,000 would show up on dad's personal tax return. If he dies in the meantime, the boys have the money to buy out the company. And if he lives for that, let's call it a 10-year period of time, if he's still kicking then and he vests in the policy, when he vests, they can say the total cash value net of taxes is $2.3 million, and I'm making up a number. That $2.3 million transfer goes against the purchase price of the business. And I'm not saying that's the whole solution, right, Mark? If it's a $70 million company, we could probably help them out with a good portion of the business.
Well, the nice thing in my situation is the dad's in his, late middle 50s, so he's still young. So it makes insurance pretty cheap.
I'm glad you said he's still young because I'll be 52 and I'm still young.
Well, it's all perspective. When you're 65, 50, really young.
Yeah. I think I was 49 the first year in business when most of my new clients were younger than me. I was like, when did that happen?
There is that transition point where you go from being the young guy to the old guy. I'm clearly the old guy now, so it's good.
And I did just see a question, how is this different than a charitable remainder trust? It's 100% different. There's actually really no overlap whatsoever. So in a CRT, although you would have access to income during your life, you're transferring that asset out away from you. Although we do have something that we termed a charitable risk of forfeiture, this is not at all intended. There's no charitable tax deduction that's ever occurring. Right. So unlike a charitable remainder trust, you give a put your $2 million apartment in there, give it to your church, and you get the income for life. You get the deduction now, and your church gets the apartment when you die. This is actually that charitable risk of forfeiture is therefore to assist with the current income tax deduction, but there's never a charitable deduction that takes place anywhere here because the goal is for this to never go to charity. If you think it's going to go to charity, put less money in. I mean, for me personally, I put less than half of what I can put into my own restricted property trust. I have a business purpose to probably put about $900,000 a year in, and I put $350,000 a year into my own trust. And that's because I'm married. And on August 10th, I'm taking my oldest daughter to the University of South Carolina, and I just paid her tuition last week. And so the 350 number for me is a number I can fund whether I'm working or not the next 4 years. 900,000, that would make me more nervous. Could I fund 900,000 a year for the next 4 years if I wasn't working? I don't know. I will say this, and Jake will understand it. I've been in, I do this business all over the country, and I have plastic surgeon clients that make $4 million a year and have $11 in their checking account. They are terrible clients because if their medical offices get closed for COVID for a month, they can't pay their mortgage. I mean, they can't even eat dinner out. Give me the dentist making $1,000 a year that lives in Wichita, Kansas, and has $2 million in the bank. They know they can fund the next 5 years, right? So the clients, I usually want to see clients that have at least 4 times the premium in non-qualified liquid assets before they commit to a number. So if you have a client that wants to put 200 grand in, one of my first questions is, do they have $800,000 somewhere in non-qualified liquid assets? Because if they do, that makes me less nervous personally.
And it's just, from like a CFO standpoint, it's proper planning, making sure
Yes.
that the cash flow is there. They're not like the plastic surgeons that don't have cash flow, and that there's savings or there's other assets that they can pull from that are liquid to be able to fund this should there be a pandemic that never happens, or should there be a lot of other things that disrupt their industry. It could be government legislation, could be a number of different things. So we don't want to set up a retirement plan that has such amazing benefits should they not be able to fund it. They don't want to be so retirement rich that they're pocketbook poor.
And one quick example on why this works from a tax perspective, the very fastest audit I've ever run in my career, I had an audit clearance letter in less than 30 days. It was the first week of April 2020, and I was on the phone with a field agent auditing a dentist client in Columbus, Ohio. And I was explaining the 5-year risk of forfeiture and the deduction on the corporate return. And she said, well, that doesn't make any sense. The dentist owns 100% of the practice, and he can just choose to pay the premium. I said, oh my gosh, what a great point. Hey, could you call the governor for the state of Ohio and let my client open up his office again? Because the governor closed down all dental offices in the state of Ohio. So maybe 100% business owners don't have control of every outside factor. She went, oh yeah, that's a good point. So that was a really fast audit. It even helped an IRS field agent to understand that our risk of forfeiture is real.
That's right. Very, very real.
Hey, Ken, I have a quick question for you.
Yeah.
I don't know if we're good to talk on here. I see a bunch
Yes.
of messages flying in, but I was just going to ask you. So we have a client kind of in their mid-30s. They have a pretty successful business, probably generating over $1 million. Your guys' threshold is $600,000 for profit, right?
Yeah. The only thing I want to see, Brennan, is I want to know their next dollar is going to be taxed in the top marginal bracket.
Okay. And so, yeah, could you talk to that a little bit? Kind of the client's mid-30s. They do have a couple children, successful business. One kind of if you could walk through the tax benefits of it. I know you kind of touched on that, but just to go full circle of the tax benefits of it, as well as the benefit of kind of the accumulated cash value in the policy and how that
You bet.
works to their advantage for retirement or even shorter than retirement because it's not a qualified asset. So if you could just
Right.
kind of walk through that, that'd be awesome.
Yep. Perfect. So let's assume we're putting 100,000 in and they were going to net out $1 million in total net income for 2022. If they put $100,000 into the restricted property trust, they would pay taxes on 930,000 instead of $1 million. So they would reduce their income by $70,000 if they put 100,000 in. So that's step one. That's going to save them about 30,000 in taxes. Step two is they have a death benefit, which is probably very attractive to the spouse with the young school, with the young kids at home. So if they die, the death benefit. What's funny is, and I'll tell you this, I sell this all the time based on the tax deduction today. Hey, you write $100,000 check, you're going to save $30,000 in taxes, and clients jump at that. Once they own it, they get far more attracted to the death benefit. My problem is I can't make them emotionally attached to the death benefit until after they own it.
Yeah. Yeah.
And so then he's accumulating, let's say at his age, he funds this for 15 years. So he would have put in $1.5 million. He would have had his income over that same period of time lowered by $1,050,000. Right. So that would have been 70% of 1.5 million.
Mm-hmm.
And then he would vest in the asset. He would have some tax due on transfer, but we would pay that out of the policy, which has some great tax efficiencies. And then he would have a very large whole life policy that he essentially funded, with call it 65, 70 cent dollars. I mean, that's really it. The RPT is essentially like buying a whole life insurance policy with 70 cent dollars if you're okay with locking your money up in 5-year rolling windows. And when you use 70 cent dollars instead of 100 cent dollars, well, the math gets a lot better.
Yeah, absolutely.
That's the long and short. I will tell you the proudest moment of my career, and Jake's heard this story a number of times, but I sold a restricted property trust, a $16 million policy to a guy in Indiana that owned car dealerships. And he hated life insurance with a passion. He was in his late 50s. He owned no life insurance. He was worth about 20 million bucks. And he hated life insurance with a passion. The only thing he hated more than life insurance was tax. So I was able to sell him a $16 million restricted property trust. 9 months later, he was diagnosed with pancreatic cancer and he died 36 days after diagnosis. My trustee cut a check to his son for $16 million, who in turn wrote a check to his 2 sisters for $8 million apiece. And the mom called my partner advisor on December 26, 2017. And she said, "Thank you so much for using that tax deduction to trick my husband into buying that life insurance policy. Because I just had my kids and grandkids over for Christmas and nobody was fighting."
Yeah.
That's all mom cared about. She didn't care about the deduction or
Yeah.
her kids and grandkids still get along.
Ken, and then I assume on the back end, say with this client of ours, in 10 years or 15 years, when it's its own policy, like we can do anything we want if it's, hey, now we want to utilize that in 1035 into premium finance or whatever. Like you can do anything you want, just like a whole life policy would do, right?
That's exactly right. Yep. As soon as he vests in the policy, your flexibility becomes 100%. Now, provided he's still insurable.
Never know.
Yes.
Yeah.
Awesome. Thanks, Ken.
Yep.
So can I ask a question just to make sure that I understand this? So basically what we're doing here is we're funding this life insurance policy where you give basically 30% off on your taxes in order to, you get 70% off.
Yep. It'll lower your net income by 70%. So like if you put 100 grand in and you were going to make $1 million, you're going to have to pay taxes on 930 instead of $1 million.
Can you, okay, so let's say you funded at 300,000.
Okay.
Would it be
210?
210?
Yep. That'll lower your net income, your taxable income by 70 cents on the dollar.
So you would pay tax on 210 if.
Nope. Pay tax on the 90.
Yep. on the
Okay,
reverse.
you only pay tax on the 90. Okay.
Yep.
So then you basically get to fund this life insurance policy, lock up your money for 5 years at a time, but you're earning 8%. I don't want to say guaranteed, but relatively as close to guaranteed as possible.
Yes, absolutely.
And
Now the
then
dividend.
you get this death benefit at the end of it that you can go ahead and borrow against it and
Well, there's a cash value. If you pass away, there's a death benefit to your family and your heirs. But otherwise, it's a cash value that you're able to use as a cash value asset, a life insurance policy that is built and structured so that as much as possible is going towards the cash value. And yes, at the end, you get that, and you can use it as any other cash value life insurance policy once it's outside of the trust.
And so the benefit over just buying a standard whole life insurance policy is that you get that 70% reduction in the taxes.
Yep, that's benefit. I will say this, ever since I won my court case in March, for the first time, now that it's impossible to consider this a potential tax shelter, we have public companies looking at this as an alternative to their deferred comp. Because in deferred compensation, either the company eats it at 100% and pays tax looking forward to a future deduction, at which point in time the executive pays 100%. Or if the company wants to enjoy that deduction today, the executive picks up 100%. So picture the restricted property trust. Company enjoys 100% deduction today, executive picks up 30% today. That's way better from a tax efficiency perspective.
Yes. So normally it's all taxable to a highly compensated employee. And
Yep.
so absolutely like it completely better in this scenario.
Yeah.
Can you use it in conjunction with other tax strategies, like inside of things? I don't know if I'm allowed to say it, but the deferred sales trust, like, could you use it in conjunction or?
So in income, so this would be just like we do a premium finance with a deferred sales trust. Income from it can be used to fund it annually. The deferred sales trust will not directly own a retirement plan unless it owned a business that funded a retirement plan.
But no interference. So if you're, I mean, I would bet you 50% of our clients, maybe more, have cash balance pension plans, cross-tested cash balance pension plan. This is not going to impact their cross-tested cash balance pension plan, their DB plan, their 401k, their DST. All of that is going to be separate, and it doesn't impact any of their funding limits. I will say one more thing from a sales tip perspective. We do a lot of business with cross-tested cash balance pension plan TPAs. And they wait till they max out, right? I literally just had an email 5 minutes before I signed into this call where I had a TPA in San Francisco go, Ken, I got a 48-year-old who's maxed out on his cash balance pension plan. He's still begging for deduction. And he can't put 300 grand in there this year. Can you help him? And of course, they never call me till they're done.
Of course.
But it's a great market because people who are fully vested in their DB plans, they still want that deduction, but they can't fund it. It's max funded. So enter the RPT. We've probably done over 100 cases from those types of scenarios.
Interesting.
Very good. Well, I think that's all we have time for today. Ken, if people want to implement this for a 2022, when is the appropriate time to get started?
Yeah, I would love to have underwriting done before Thanksgiving. The first Friday in December is the last Friday to engage the law firm, because we you know, I mean, you guys are in the tax business. We do 85% of our trusts in the fourth quarter. And so it's just a zoo. And I've got 3 different law firms and my team's running air traffic control to see which firms have the bandwidth to get everything done. And so we now give them at least 3 full weeks to be engaged to draft the trust and fund it prior to 12/31. So basically everything needs to be done. The underwriting, the proposal, the client said yes, and they retained the law firm by the first Friday in December.
By the first Friday in December. Now, prior to the first Friday in December, when everything must be done, underwriting. Now, even though a lot of these insurance companies are offering, up to a certain death benefit, like non-liquid underwriting, all this other stuff, this is different because this is a business policy. And so
We use ACE a lot. We use the online. I actually just added $7.5 million of death benefit to my own portfolio via ACE last week.
And we did an ACE application as well last week, and it was like 26 hours later, we had an offer.
Awesome. But don't count on that. The only thing, and you're bringing up a great point. These accelerated client experiences with the no blood and urine underwriting are great. If there's any hiccup that pops up in that online testing, that means we have to order medical records. And that is if you're looking to order medical records around Thanksgiving, this ain't happening in 2022.
Right. A lot of times it's dependent upon the doctor's office responding. We had an experience last year where the doctor's office was a specialty chiropractor. It was just something strange and different. And they didn't want to release the medical records of the client, which meant that the client wasn't able to get the policy in that year. And so kind of a bummer, right? But I guess the point we're trying to make is the perfect timing is now, so to speak. Like, get into this, review it, get an underwriting offer, review all of your options, make sure that this is the dessert at your dinner table, not the entree. And let's go through the analysis, talk with your tax advisor, talk with your financial advisor, talk with your family, make sure that this business retirement plan also fits into family financial planning as well. And that way you're not making a last minute tax decision. We're making an actual business decision for a retirement plan that has all these other benefits and that it works in conjunction with your other plan.
Yeah, and I think you'll all resonate with this. I tell people that I'm using tax efficiency to incentivize clients to do the planning they should do anyway.
Exactly.
I mean,
What are
really.
the fees?
Yeah, great question. So the law firms, and this is why I only have 3, I'm really expanding, but I promise every law firm at least 30 trustees so I can keep their fees down so they can, churn it out like lab rats. I don't think any of them are on the call, so that's good. But it's $5,000 flat for the trust plus $1,000 per participant. And, one person, $6,000, people $7,000. In years 2 and beyond, the trustee is going to only charge a flat fee of $500 per policy, $1 million or $50,000. Because of those fees, we think our case minimum is $50,000. Because if I have a client wanting to put $20,000 in, they're going to pay $6,000 for a trust, and they start arguing with me about the fees, I'm like, well, then just put more money. And at $50,000, then those fees, it's a little bit more expensive than a cross-tested cash balance pension plan in year 1, but year 2 and beyond is $500 flat per year per policy, which is the biggest Achilles heel in my entire business. Is I have 2 trust companies and they still charge me that. I'm about to max them out, and I have 2 other trust companies that want to work with me, but they're going to be $1,250 per year. And so I'm dragging my feet as long as possible because I can't find another trust company to offer this service at $500 flat.
From the TPA perspective, trying to make everything as efficient as possible for the retirement plan, it's important to keep those fees manageable.
Yes, sir. Yep. I'm trying to get volume discounts for everybody all the time.
Ken, I assume these fees we can deduct as the business?
100%.
All right. Well, very good. That's all the time we have for today. If you have more questions, you can reach out. I have a website where a lot of this stuff will be posted. There'll be a podcast from today. So if you're at the gym and you want to listen in, feel free. The sound bite from today's session with Ken Crabb will be available in about a week, as well as Ken, we'll have you back probably here in October for those last minute people who want to try and get in, who've been looking at this for the last couple of months and want to know if last minute they can still do this.
The only thing I'd say is when I'm in the gym, I listen to 80s hair metal. Tax thing would be really motivational for lifting, but hey.
All right. Well, thank you, Ken. Thank you so much for coming in today.
All right.
And
thanks for having me. Great to see you. Sorry, I'm sure Micklean's noticed that gray, but it's slower when you see him every day, right?
Oh my. Well, there you go.
Look at me. Who am I to talk?
Well, very good. Well, we might have to have one of these speaking engagements in, Mexico, Colombia, Panama, somewhere fun and tropical. So we'll try to plan for that tax deductible event, and we'll have you as one of those speakers, Ken, for sure.
Awesome. Thank you, guys. It was a pleasure to be with you today. And Jake, I'll always look forward to reconnecting, my friend.
Thanks again, Ken. Thanks everyone for joining. Goodbye.
See you guys.